Welcome to this beginner-friendly CAMS seminar 1 lesson. This session focuses on money laundering risks in depository institutions. That means I am learning how money laundering works, why banks and similar institutions are vulnerable, and how certain banking products can be abused. This lesson is written in first person on purpose. That means I will keep hearing statements like, I understand that money laundering means making criminal proceeds appear legitimate. When I see cash entering the financial system, I think placement. When I see multiple transfers designed to hide the trail, I think layering. When I see money returning as property, investments, or business income, I think integration. This matters because I do not want to passively listen. I want to internalize the material. I want the language to become familiar. I want to hear the concepts in a way that I can repeat back to myself. This video is designed for repeated listening. The first listen is for understanding. The second listen is for memory. The third listen is for active recall. On the third listen, I should pause after each section and explain the concept out loud. That is how I turn passive study into exam-ready thinking. This video is for educational purposes only. It is not legal advice, regulatory advice, exam provider advice, or employer-specific guidance. Nothing here represents any employer, regulator, bank, or official exam provider. The aim is simple. I want to understand CAMS Seminar 1 in plain English. I want to connect the exam concepts to real banking logic. And I want to leave this lesson thinking more clearly about AML risk. Money laundering is not just about criminals walking into banks with bags of cash. Money laundering is about disguising criminal value so it can move through the financial system without attracting attention. Before I memorize AML terms, I need to understand the story. Dirty money enters the system. The trail is disguised. Then the money comes back looking legitimate. That simple story is the foundation of CAMS Seminar 1. In this lesson, I am going to train myself to think like an AML professional. I am not just memorizing definitions. I am learning how the system works. I am learning how criminals misuse banks. And I am learning how financial institutions respond through customer due diligence, screening, monitoring, escalation, and suspicious activity reporting. This is the first of 6 YouTube videos that will cover all topics in relation to the CAMS exam. In this first video, we will cover 1. What money laundering means. 2. Willful blindness. 3. Placement, layering, and integration. 4. Economic and social harm. 5. Adverse consequences for financial institutions. 6. Why banks and depository institutions are vulnerable. 7. Electronic funds transfers. 8. Remote deposit capture. 9. Correspondent banking. 10. Payable-through accounts. 11. Concentration accounts. 12. Private banking. 13. Politically exposed persons. 14. Structuring and microstructuring. 15. Credit unions and building societies. 16. How financial institutions turn AML rules into controls. And finally, how I should think during CAMS questions. Chapter 1. What money laundering means. I start with the simplest definition. Money laundering means taking criminal proceeds and making them appear legitimate. In plain English, it means making dirty money look clean. But I need to be careful. Money laundering is not only cash. It is not only drug money. It is not only someone depositing money into a bank account. Money laundering can involve property, assets, bank transfers, companies, investments, luxury goods, loans, insurance products, securities, real estate, or almost any other method of moving value. For exam purposes, I need to remember 3 core ideas. Money laundering can involve converting or transferring criminal property. It can involve concealing or disguising criminal property. And it can involve acquiring, possessing, or using criminal property. So my beginner memory hook is move it, hide it, use it. Move it means transferring or converting criminal property. Hide it means concealing the source, ownership, location, movement, or true nature of the property. Use it means acquiring, possessing, or using property while knowing it came from crime. In a banking context, this matters because a financial institution may not always see the original crime. The bank may only see the movement of money. The question becomes, does this money movement make sense? Does the customer's activity match what the institution knows about them? Is the source of funds clear? Is the source of wealth clear? Is the ownership clear? Is there a legitimate business or personal reason for the activity? When I see a CAMS question about money laundering, I should not only ask, was there cash? I should ask, is criminal value being moved, hidden, or used? First person reinforcement. I understand that money laundering is not just about cash. I understand that money laundering is about making criminal value appear legitimate. I remember the basic rule: move it, hide it, use it. Chapter 2, Willful Blindness. Now I move to willful blindness. Willful blindness means deliberately avoiding knowledge of suspicious facts. In plain English, it means I cannot close my eyes to risk and then claim I did not know. If the facts are suspicious and I intentionally avoid asking questions, that can be treated as knowledge in some legal contexts. The key phrases are deliberate avoidance of knowledge, purposeful indifference. This matters because AML is not only about what I actually know, it is also about what I should reasonably recognize from the facts in front of me. If a customer's profile says they operate a small local business, but the account suddenly receives large international wires from high-risk jurisdictions with no clear explanation, I cannot simply ignore that. If a customer refuses to explain their source of funds, I cannot pretend that refusal means there is no issue. If someone structures transactions below reporting thresholds, I cannot treat each transaction as harmless, just because each one is technically small. Willful blindness is an exam trap, because a question may describe someone who avoids asking obvious questions. The wrong answer may focus on the person saying, I did not actually know. The better answer recognizes that avoiding knowledge can still create responsibility. Memory hook. Closing my eyes does not erase the risk. First person reinforcement. I understand that willful blindness means deliberate avoidance of suspicious facts. I understand that purposeful indifference can be treated like knowledge. When I see someone avoiding obvious red flags, I think willful blindness. Chapter 3, Placement, Layering, and Integration. Now I move to the 3 stages of money laundering. This is one of the most important foundations in AML. The 3 stages are placement, layering, integration. I need to know them so well that I can recognize them in a scenario. Placement means the criminal proceeds enter the financial system. Layering means transactions are used to disguise the trail. Integration means the money returns into the economy appearing legitimate. The easiest memory hook is placement puts it in, layering hides the trail, integration brings it back. Let me slow that down. Placement is the first stage. This is where illegal funds are introduced into the financial system. Examples include cash deposits, breaking large amounts into smaller deposits, buying monetary instruments, transporting cash across borders, using casinos, or buying high-value goods that can later be resold. The exam logic is simple. When I see dirty money entering the financial system, I think placement. Layering is the second stage. This is where the trail becomes harder to follow. The criminal may move funds between accounts, between banks, between countries, or through companies. The criminal may convert funds into other forms. They may use shell companies. They may move money through wires, securities, insurance products, or business transactions. The point of layering is not just movement. The point is confusion. Layering creates distance between the money and the crime. So when I see complex movement, offshore transfers, shell companies, circular transactions, or unclear ownership, I think layering, integration is the third stage. This is where the money returns looking legitimate. The criminal may buy real estate. They may invest in a business. They may buy luxury assets. They may receive money back as investment income, loan repayment, business revenue, or proceeds from a sale. At this stage, the money appears clean. That is why integration can be difficult to detect. The money may now look like ordinary wealth. The exam trap is that these stages can overlap. A real scheme may not happen in a neat order, but for CAMS questions, I should identify the main purpose of the activity. Is the money entering? That is placement. Is the trail being hidden? That is layering. Is the money coming back as apparently legitimate wealth? That is integration. First-person reinforcement. When I see money entering the financial system, I think placement. When I see confusing movement, I think layering. When I see money returning as property, investments, business revenue, or luxury assets, I think integration. Placement puts it in. Layering hides the trail. Integration brings it back. Mini recap 1. Let me pause. So far, I know 3 things. Money laundering means making criminal proceeds appear legitimate. Willful blindness means deliberately avoiding suspicious facts. And the 3 stages are placement, layering, and integration. If I only remember one thing so far, it is this. AML is about recognizing how value is moved, hidden, and reintroduced. Chapter 4: Economic and Social Harm. Now I need to understand why money laundering matters. AML is not just paperwork. It is not just forms. It is not just compliance language. Money laundering causes real harm. It supports organized crime. It allows corruption to continue. It weakens financial institutions. It damages public trust. It can distort markets. It can reduce tax revenue. It can discourage foreign investment. It can undermine legitimate businesses. It can expose countries to sanctions or international pressure. It can increase crime and corruption. One important idea is that money laundering can undermine the legitimate private sector. Criminals may use front companies. A front company looks like a normal business, but it is actually being used to mix illegal money with legitimate money. Because the criminal business has access to illicit funds, it may be able to sell goods or services below normal market prices. That makes it harder for honest businesses to compete. So the harm is not abstract. Dirty money can affect real markets. It can reward dishonest businesses. It can punish legitimate businesses. It can corrupt officials. It can weaken institutions. It can make an entire country or financial system look risky. The memory hook is, dirty money does not stay isolated. It spreads harm. First-person reinforcement. I understand that AML is not just paperwork. I understand that money laundering can harm countries, markets, communities, and financial institutions. When I see a question about the impact of money laundering, I think beyond the bank account. I think about crime, corruption, reputation, markets, tax revenue, and public trust. Chapter 5: Adverse Consequences for Financial Institutions. Now I focus on the harm to financial institutions. The key categories are reputational risk, operational risk, legal risk, concentration risk. Reputational risk means loss of trust. If a bank is linked to money laundering, customers, investors, regulators, and other banks may lose confidence in it. Even if the institution survives, its reputation may be damaged. Operational risk means loss caused by weak systems, weak controls, poor processes, human error, or external events. If transaction monitoring fails, if customer information is incomplete, if suspicious activity is not escalated, or if records are poor, the institution may suffer operational consequences. Legal risk means lawsuits, penalties, fines, regulatory action, unenforceable contracts, or even closure. This is the risk of legal consequences. Concentration risk means too much exposure to one borrower, group of borrowers, related parties, or common source of repayment. In AML, concentration risk can increase when the institution does not truly understand who controls the customer or how related parties are connected. The memory hook is, bad AML can damage trust, systems, law, and exposure. Trust is reputational risk. Systems are operational risk. Law is legal risk. Exposure is concentration risk. Exam trap. If the question says negative publicity, think reputational risk. If the question says weak processes or systems, think operational risk. If the question says lawsuits, fines, penalties, or unenforceable contracts, think legal risk. If the question says too much exposure to one borrower or connected group, think concentration risk. First-person reinforcement. When I see a question about harm to a financial institution, I ask, is this reputational, operational, legal, or concentration risk? Chapter 6: Why Banks and Depository Institutions Are Vulnerable. Now I move into banking. Banks are important to money laundering because they move value, they hold money, they process payments, they connect customers to other customers, they connect countries to other countries, they convert value, they provide products, they create records, and they can make money movement look normal. This is why banks are vulnerable. A criminal wants access to the financial system because access can create legitimacy. Once money has moved through a bank account, a wire transfer, a loan repayment, or an investment, it may look more normal than cash from a crime. Banks are also vulnerable because of speed and volume. There are huge numbers of transactions. Many are legitimate. Illicit activity can hide inside normal activity. Criminals may exploit cross-border transfers, third-party payments, complex ownership, high-risk jurisdictions, shell companies, professional intermediaries, weak customer due diligence, or poor transaction monitoring. The exam logic is this: banks are not suspicious by nature. Banking products are not suspicious by nature. The risk comes from how the product is used. A wire transfer can be legitimate. but a wire transfer to a high-risk jurisdiction with no business purpose may be suspicious. Private banking can be legitimate, but private banking with secrecy, complex offshore entities, and unclear source of wealth may create higher risk. A credit union can be lower risk, but unusual third-party cash activity can still be suspicious. Memory hook. Banks move value, so AML must understand value. First-person reinforcement. I understand that banks are vulnerable because they move, hold, convert, and legitimize value. When I review banking activity, I ask, does the movement of value make sense? Mini recap 2. Let me pause again. Money laundering harms more than one account. It can harm countries, communities, markets, and financial institutions. For financial institutions, I remember 4 risk types: reputational, operational, legal, concentration, and I understand why banks matter. Banks move value, so AML has to understand whether that value makes sense. Chapter 7. Electronic funds transfers. Now I move to electronic funds transfers. An electronic funds transfer is a transfer of money initiated by electronic means. It can happen through wire transfers, automated clearinghouse payments, online transfers, mobile banking, automated teller machines, or other electronic systems. The key issue is speed. Electronic transfers can move money quickly between accounts, banks, and countries. That makes them useful for legitimate commerce, but it also makes them useful for money laundering. Electronic transfers are especially important in layering. Why? Because layering is about creating distance from the original source. If money moves from one account to another, then to another bank, then to another country, then into another company, the trail becomes harder to follow. Risk indicators include transfers to or from high-risk jurisdictions without a clear reason, large incoming transfers for a foreign client with little explanation, many small, incoming transfers followed quickly by wires to another city or country, unexplained repetitive funds activity, payments or receipts with no apparent link to legitimate contracts, goods, or services, transfers involving the same person across different accounts. The exam trap is that fast movement is not automatically suspicious. The question is whether the movement makes sense. A global business may have international payments. A student may receive family support from abroad. A company may pay suppliers overseas. But if the activity does not match the customer profile, the stated business, the expected activity, or the available explanation, the risk increases. How do financial institutions respond? They use customer due diligence. They understand the purpose of the account. They collect expected activity information. They monitor transactions. They screen parties where required. They investigate alerts. They escalate unusual activity. And where appropriate, they file suspicious activity reports. Memory hook. Fast money needs a clear reason. First-person reinforcement. When I see fast transfers with no clear business purpose, I think layering risk. When I see money moving quickly across accounts or jurisdictions, I ask, why is it moving? Who benefits? Does it match the customer? Chapter 8. Remote deposit capture. Now I move to remote deposit capture. Remote deposit capture allows a customer to scan or photograph a check and send the image to the bank for deposit. In plain English, the customer does not need to physically go to a branch to deposit the check. This is convenient, it reduces friction, it helps customers, but it can create AML and fraud risk if controls do not keep up. The risk is that less human review may occur at the point of deposit. A customer may be able to deposit checks remotely, quickly, repeatedly, or through multiple devices. Remote deposit capture may also be misused with altered checks, duplicate deposits, sequentially numbered money orders, or unusual volumes. The more prominent risk is often fraud, but fraud and money laundering can overlap. If someone uses fraudulent checks to create funds and then moves those funds onward, AML concerns may arise. Risk controls include integrating remote deposit capture into monitoring and fraud prevention systems. Institutions should review items submitted through remote deposit capture. They should monitor total activity. They should set deposit limits. They should offer the product only to appropriate customers. And they should act quickly when fraud is detected. The exam trap is to treat remote deposit capture as just a technology convenience. But CAMS wants me to see product risk. A new product can create new abuse opportunities. Memory hook. Convenience still needs controls. First-person reinforcement. I understand that new banking technology can create new AML and fraud risks if controls do not keep up. When I see remote check deposits or mobile check images, I think, are monitoring, limits, and fraud controls integrated? Chapter 9, Correspondent Banking. Now I move to one of the most important banking topics, correspondent banking. Correspondent banking means one bank provides services to another bank. A simple example is this. A foreign bank may use a larger bank to process international transfers for its customers because it does not have that service itself. The bank providing the service is the correspondent bank. The bank receiving the service is the respondent bank. Correspondent banking allows banks to provide services in countries where they do not have a physical presence. For example, a bank outside the United States may need access to US dollar clearing. It may use a correspondent bank to process payments. This is legitimate and important for global finance, but the AML risk is indirectness. The correspondent bank may not know the respondent bank's customers directly. The correspondent bank may be processing transactions for underlying customers it has never onboarded. That creates a know your customer's customer problem. The correspondent bank often relies on the respondent bank's AML controls. So the correspondent bank needs to understand the respondent bank. It should understand the respondent's jurisdiction. It should understand ownership and management. It should understand the customer base. It should understand the products and services offered. It should understand whether the respondent bank has strong AML controls. It should understand whether there is nesting. Nesting occurs when another financial institution accesses the financial system through the respondent bank's correspondent account instead of having its own direct correspondent relationship. That can increase opacity because there may be another layer between the correspondent bank and the underlying activity. The exam trap is confusing correspondent banking with payable-through accounts. Correspondent banking is bank-to-bank. Payable-through accounts involve more direct access by the foreign bank's customers. Memory hook. Correspondent banking is bank-to-bank access. First-person reinforcement. When I see one bank providing services to another bank, I think correspondent banking. When I see indirect access to customers I do not know directly, I think correspondent banking risk. Chapter 10, Payable-through accounts. Now I move to payable-through accounts. A payable-through account is a type of correspondent banking arrangement where the respondent bank's customers can conduct their own transactions through the respondent bank's account at the correspondent bank. In plain English, the foreign bank's customers may be able to directly use the account. They may send wire transfers. They may make deposits. They may withdraw funds. They may maintain check-in access. The key distinction is this. In traditional correspondent banking, the respondent bank takes instructions from its customers and passes them to the correspondent bank. In a payable-through account, the foreign bank's customers have more direct control over funds at the correspondent bank. That creates higher risk because the correspondent bank may not know the underlying users. The correspondent bank may think its customer is only the respondent bank, but in practice, many sub-account holders or underlying customers may be using the account. Those users may include individuals, businesses, exchange houses, finance companies, or even other banks. The AML concern is visibility. Who is actually using the account? Has anyone identified them? Has anyone verified them? Does the bank understand their source of funds? Is the respondent bank monitoring them properly? Are the transactions consistent with legitimate activity? Payable-through accounts are not automatically prohibited, but they need strong controls. A financial institution should understand the ultimate users. It should review the foreign bank's customer identification and monitoring procedures. It should understand local requirements placed on the foreign bank. It should monitor the payable-through account for unusual or suspicious activity. The exam trap is confusing payable-through accounts with ordinary correspondent accounts. The memory hook is, if the underlying customers can directly use the account, think payable-through account. First-person reinforcement. When I see direct access by a foreign bank's customers, I think payable-through account. Correspondent banking is bank-to-bank. Payable-through accounts create direct customer access. This distinction matters. Chapter 11, Concentration accounts. Now I move to concentration accounts. A concentration account is an internal account used by a financial institution to process or settle multiple customer transactions. These accounts may also be called omnibus accounts, settlement accounts, suspense accounts, intraday accounts, sweep accounts, special use accounts, or collection accounts. The important word is internal. A concentration account is not mainly about a foreign bank's customers. It is not the same as a payable-through account. It is an internal processing account. These accounts can be legitimate and useful. They may help a bank process many transactions efficiently, but they create AML risk if customer identifying information gets separated from the transaction. If the bank sees money moving through a concentration account but cannot clearly connect it back to the customer, the account, the amount, or the purpose, then the audit trail becomes weak. The risk is opacity. The problem is not that concentration accounts are automatically bad. The problem is lost transparency. A strong control environment should retain customer and transaction information. It should prevent direct customer access. It should reconcile accounts. It should monitor recurring customer names. It should capture transactions on customer statements. It should maintain a clear audit trail. The exam trap is to confuse concentration accounts with correspondent banking or payable-through accounts. Here is the distinction. Correspondent banking is bank to bank. Payable-through account is direct access by the foreign bank's customers. Concentration account is internal bank processing with audit trail risk. Memory hook. Internal processing can create external opacity. First-person reinforcement. When I see an internal account that makes it harder to trace customer activity, I think concentration account risk. I remember internal account, processing function, audit trail risk. Mini recap 3. Let me pause. Electronic transfers are risky because money can move quickly. Remote deposit capture is risky because convenience can reduce human review. Correspondent banking is bank-to-bank access. Payable-through accounts involve direct access by the foreign bank's customers. Concentration accounts are internal accounts with audit trail risk. If I can explain those differences, I am getting stronger. Chapter 12, Private Banking. Now I move to private banking. Private banking provides personalized financial services to wealthy clients. These clients may be high net worth or ultra high net worth individuals. Private banking is not suspicious by itself. Wealth is not suspicious by itself. The risk comes from opacity, complexity, secrecy, influence, and unclear sources of wealth or funds. Private banking may involve confidentiality. It may involve offshore structures. It may involve private investment companies. It may involve trusts or legal entities. It may involve assets in multiple jurisdictions. It may involve powerful clients. It may involve close relationships between relationship managers and clients. It may involve commission pressure. It may involve a culture where the client's commercial value creates pressure to move quickly. That is where AML risk can appear. A private banking client may have legitimate wealth, but the institution still needs to understand the customer. Who owns the assets? Who controls the assets? Where did the wealth come from? Where are the specific funds coming from? Why is the account being opened? What products will be used? Is there political exposure? Are there offshore entities? Are there nominees or complex beneficial ownership structures? Does the expected activity make sense? Enhanced due diligence is often important in higher risk private banking relationships. This can include understanding source of wealth, source of funds, beneficial ownership, purpose of the relationship, expected activity, screening, and ongoing monitoring. A key private banking exam trap is assuming the risk is simply wealth. That is too simple. The better answer is that risk increases when wealth is combined with secrecy, complex structures, political exposure, offshore vehicles, unclear source of wealth, or weak due diligence. Memory hook. Wealth is not the risk. Unexplained wealth is the risk. First-person reinforcement. When I see wealth plus secrecy, offshore structures, political exposure, or unclear source of wealth, I think enhanced due diligence. I understand that private banking requires strong controls because powerful relationships should not weaken AML standards. Chapter 13, Politically Exposed Persons. Now I move to politically exposed persons. A politically exposed persons, or PP, is someone who holds or has held a prominent public function. This can include senior politicians, heads of state, senior government officials, senior military officials, senior judicial officials, senior executives of state-owned corporations, or important political party officials. There are three broad categories: foreign PEPs, domestic PEPs, international organization PEPs. Foreign PEPs are people entrusted with prominent public functions by a foreign country. Domestic PEPs are people entrusted with prominent public functions within their own country. International organization PEPs are people entrusted with senior roles in international organizations. Relatives and close associates may also be relevant depending on the framework. A PEP is not automatically criminal. This is very important. The risk is not that every PEP is bad. The risk is exposure. PPs may have access to public funds. They may have influence. They may be exposed to bribery attempts. They may be linked to corruption risk. They may be able to influence government decisions. They may have family members or close associates used to move funds. This is why PPs often require enhanced scrutiny. The exam trap is moralizing the concept. Do not think PP equals criminal. Think PP equals influence risk. A financial institution should understand the source of wealth and source of funds. It should screen for political exposure. It should consider adverse media. It should understand beneficial ownership. It should monitor activity. It should escalate where appropriate. Memory hook. PEEP risk is influence risk. First-person reinforcement. When I see political power, public influence, or close association with power, I think enhanced scrutiny. I understand that a PEP is not automatically criminal, but the relationship may require stronger due diligence. Chapter 14. Structuring and microstructuring. Now I move to structuring. Structuring means designing transactions to avoid triggering reporting or record-keeping requirements. In plain English, someone breaks activity into smaller pieces to avoid attention. For example, instead of making one large cash deposit, a person makes several smaller deposits. Instead of one transaction above a reporting threshold, they make multiple transactions below the threshold. The important point is intent. Small transactions are not automatically suspicious. The issue is small on purpose. The person is trying to avoid reporting, record keeping, or detection. Structuring is one of the most common money laundering methods. It can happen in banks, money services, businesses, casinos, and other settings. Smurfing is a form of structuring. It may involve multiple people making multiple small transactions to avoid detection. Runners may go from one financial institution to another depositing cash or buying monetary instruments in smaller amounts. Microstructuring is the same idea at a smaller level. Instead of breaking money into a few smaller deposits, the person may break it into many very small deposits. That makes the pattern harder to detect. Red flags can include frequent deposits just below thresholds, multiple branch visits, multiple people conducting similar activity, cash deposits followed by ATM withdrawals, third-party cash deposits into business accounts, frequent activity soon after account opening, activity inconsistent with the customer profile. The exam trap is focusing only on the individual transaction. A single deposit may look normal, but the pattern may be suspicious. AML is often about seeing the pattern. Memory hook. Small pieces can still show one big pattern. First-person reinforcement. When I see repeated small transactions designed to avoid attention, I think structuring. When I see very small repeated transactions designed to avoid attention, I think microstructuring. I remember small is not the issue. Small on purpose is the issue. Chapter 15. Credit unions and building societies. Now I move to credit unions and building societies. Credit unions are not-for-profit, member-owned financial cooperatives. In some jurisdictions, similar institutions are called building societies. They usually do not have customers in the same way banks do. They have members. Those members are also owners. Membership is often based on a common bond. That common bond may be a community, employer, organization, religion, or place of employment. Credit unions and building societies may be lower risk than large complex banks because they may have a smaller, more local membership base and fewer products. But lower risk does not mean no risk. They still accept deposits. They still provide accounts. They may process payments. They may offer loans. They may have cash activity. They may deal with third parties. They may be exposed to unusual account behavior. The more financial services they offer, the higher the potential risk. Risk indicators may include third-party money transfers, third parties paying cash on behalf of someone else, reluctance to provide identity information, frequent cash payments, large one-time transactions inconsistent with the member profile, unusual loans or savings transactions, early repayment of a loan from an unknown income source. The exam trap is assuming small or community-based means exempt from AML risk. That is wrong. The better answer is risk-based. A credit union may be lower risk, but it still needs appropriate AML controls. Memory hook. Smaller institution does not mean smaller risk. First-person reinforcement. I understand that credit unions and building societies may be smaller or community-based, but they still need AML controls. When I see unusual third-party activity, cash activity, or reluctance to provide identity information, I still think AML risk. Mini recap 4. Let me pause again. Private banking risk is not simply wealth. It is unexplained wealth, secrecy, complexity, offshore structures, political exposure, and weak due diligence. PEP risk is influence risk. Structuring is small on purpose. Microstructuring is even smaller on purpose. Credit unions can be lower risk, but they are not no risk. The exam keeps testing the same skill. Can I recognize when activity creates opacity, concealment, or unexplained risk? Chapter 16. How financial institutions turn AML rules into real controls. Now I want to connect the exam material to real banking implementation. AML rules become real through controls. In general, financial institutions implement AML requirements by identifying the customer. That means collecting basic information. They verify the customer. That means confirming the customer is who they say they are. They understand beneficial ownership. That means identifying the real people who ultimately own or control an entity. They understand the purpose of the account. That means asking why the customer wants the relationship or product. They understand source of wealth. Source of wealth means how the customer generally built their overall wealth. They understand source of funds. Source of funds means where the specific money used in a relationship or transaction came from. They risk rank the customer. That means assessing risk based on factors such as geography, occupation, entity type, products, activity, political exposure, sanctions exposure, and expected behavior. They screen. Screening may include sanctions screening, politically exposed person screening, and adverse media screening. They monitor activity. Monitoring means comparing expected activity against actual activity. They escalate unusual activity. Escalation means sending concerns to the right AML, compliance, or investigation function. They report suspicious activity where required. Suspicious activity reporting means reporting concerns to the appropriate authority under applicable law or regulation. They conduct ongoing review. Ongoing review may include refreshing customer information through periodic reviews or event-driven reviews. This is how the theory becomes real. A definition becomes a control. A red flag becomes a review. A review becomes an escalation. An escalation may become a suspicious activity report. The exam may not always ask me about every operational step, but understanding the control logic helps me answer scenario questions. First-person reinforcement. I understand that AML rules become real through identification, due diligence, screening, monitoring, escalation, reporting, and ongoing review. When I see a risk, I ask, what control should respond to this risk? Chapter 17. How I think during CAMS questions. Now I want to train my exam thinking. When I see cash entering the system, I think placement. When I see rapid transfers, offshore movement, shell companies, or confusing transaction trails, I think layering. When I see money returning as investments, property, business income, luxury assets, or loan repayments, I think integration. When I see one bank serving another bank, I think correspondent banking. When I see a foreign bank's customers directly accessing an account, I think payable-through account. When I see an internal processing account with weak transparency, I think concentration account. When I see wealthy clients, secrecy, offshore structures, complex ownership, unclear source of wealth, or political exposure, I think private banking risk and enhanced due diligence. When I see political power or close association with public power, I think PEP risk. When I see many small deposits below a threshold, I think structuring. When I see very small repeated transactions designed to avoid attention, I think microstructuring. When I see remote check deposits or mobile check images, I think remote deposit capture and ask whether fraud and AML controls are integrated. When I see negative publicity, I think reputational risk. When I see weak systems or processes, I think operational risk. When I see lawsuits, penalties, or fines, I think legal risk. When I see too much exposure to one borrower or related group, I think concentration risk. When I see someone avoiding obvious suspicious facts, I think willful blindness. When I see a question that feels complicated, I slow down and ask, what is being hidden? Who owns or controls the money? Where did the money come from? Why is it moving? Does the activity match the customer? What would a financial institution need to understand? That is how I think like an AML professional. Final recap. Now I bring everything together. I understand that money laundering means making criminal proceeds appear legitimate. I understand that money laundering can involve moving, hiding, or using criminal property. I understand that willful blindness means deliberately avoiding suspicious facts. I understand that placement, layering, and integration are the core money laundering cycle. Placement puts the money in, layering hides the trail, integration brings it back. I understand that money laundering can harm countries, communities, markets, and institutions. I understand that financial institutions can face reputational, operational, legal, and concentration risk. I understand that banks are vulnerable because they move, hold, convert, and legitimize value. I understand that electronic funds transfers are useful for layering when they move funds quickly without a clear business reason. I understand that remote deposit capture is convenient, but convenience still needs controls. I understand that correspondent banking is bank-to-bank access. I understand that payable-through accounts involve direct access by the foreign bank's customers. I understand that concentration accounts are internal accounts with audit trail risk. I understand that private banking risk increases when wealth is combined with secrecy, complexity, offshore structures, unclear source of wealth, or political exposure. I understand that PEP risk is influence risk. I understand that structuring is small on purpose. I understand that microstructuring is even smaller on purpose. I understand that credit unions and building societies may be lower risk, but they are not no risk. And I understand that AML professionals must keep asking, who is the customer? Where did the money come from? Why is it moving? Who benefits? Does the activity make sense? Thanks for making it all the way to the end. Again, please listen to this lesson more than once. The first time, focus on understanding. The second time, focus on the memory hooks. The third time, pause after each section and explain the concept out loud. That is how this material starts becoming exam ready. Repeat this to yourself. I am not just memorizing AML words. I am learning how to think through risk. I am learning how to recognize patterns, and I am learning how to think like an AML professional. I'll see you in the next video for Seminar 2 once you're ready.